Sure, you could argue that pinning the bearish tail on the banks is a simplistic explanation. We know the banks have caused enough problems already. We know some of them are still teetering. No need to push them over on the show. But we're beginning to see the effects of our mini banking crisis, and it's making some investors real skittish. Investors like Jamie Dimon, the CEO of JP Morgan, who wrote in his annual letter that came out this morning that the crisis isn't over and there's more damage to come. We're worried about what's known as liquidity. Meaning, do we have enough robust markets for companies to raise cash? We're worried about credit. Meaning, will banks still lend money to companies that want to expand or individuals who want to buy cars or homes? And we're worried about defaults. Defaults on big office building towers, defaults on small businesses, defaults on all sorts of loans that are needed, defaults on the money that you have to buy for just to keep your goods in the store. Yeah, we're worried about all those, and we're worried because the consumer's finally feeling pain and may not be able to do any buying. Where did this palpable sense of fear suddenly come from? The fear that's devastating the stocks of great companies that are hostage to the state of the broader economy? The bond market, that's where. The bond market. We came in today, rates moving higher, sign of better times to come, pretty calm. There didn't seem anything on the horizon that would make people feel that credit could be hard to come by. Just the opposite. Things felt normal, or at least as normal as they can get after a period where 3 ne'er-do-well banks get destroyed by skittish depositors in flight. But then we got the latest job openings and labor turnover survey, also commonly referred to as the JOLTS numbers, and there were far fewer job openings than we expected. That could mean that businesses feel uncertain or they're actually trying to figure out if they should be laying off people. You don't do much hiring when you're in the middle of mass layoffs. We also got negative readings for factory orders and durable goods orders, which seemed to confirm the idea of a softer macro environment. It was virtually a trifecta of weakness when we figured at least one of those numbers would show some strength. Either way, the trio triggered an extreme response in the bond market, which you know is much, much larger than the stock market. As I mentioned, bond yields have been drifting higher all morning, then boom, lightning speed. When the downbeat news came out, rates spun lower, going down to levels where we sense that maybe the Fed has already overshot in its attempts to slow the economy, and we're heading right into a recession. It's one of the biggest declines we've seen in months. Now, I don't like to play this recession, no recession game. It's something that forces traders to choose a side. There's a camp that says the earnings will fall apart, a camp that says they'll be good only for companies that don't need a strong economy or healthy credit market, and then there's a third group that says strong balance sheets that don't have to fret about access to capital means higher stock prices. Even though I try to be an elder statesman, I'm going to be gratuitously dismissive of all three camps because that's what they deserve. Let's tackle the first camp, the one that says earnings will fall apart. Look, we don't know about the earnings are going to be yet. Earnings season's right around the corner. But the idea that earnings are collapsing simply just doesn't jive with anything anyone said at virtually any company I follow. And I follow a gazillion companies. In reality, things are okay. Sure, there can be a handful of tech companies that will report a weak quarter. Some retailers will certainly miss. And even as JP Morgan's Dimon let loose that broadside about how the banking crisis is still with us, at the same time that he said interest rates could stay higher for longer, that's a combo that would definitely be a recipe for
the house of pain.
For earnings. But if the earnings were really about to collapse, you would have spotted some evidence of this beyond the decline in stock prices by now. If anything, I believe the collapse of a couple of banks could be equivalent to a 100 basis point rate hike. Yeah, 425s from the Fed in terms of reduced bank lending. I mean, you can impute that big a rate hike from these falling banks. And if that's the case, then, well, frankly, the Fed's mostly done tightening. And if the Fed's done tightening, well, you know what you have to do. You have to be not sell. The economically sensitive stocks are where you need to be. They're the ideal place to be if the Fed's finished, actually. Always have been, always will be. So by all means, scoop some of them up tomorrow morning in this cesspool of selling. We did it for CNBC's Investing Club, and I got to tell you, we're itching to buy more. Yes, into tomorrow's session. The second camp says the slowdown's upon us. So it's time to buy the defensives. Now, I like these stocks very much. We own farming, consumer packaged goods plays galore for the Travel Trust. But just 2 weeks ago, with the same backdrop minus some jobs wanted number, these very same stocks were being pummeled because they were too defensive. And the business just isn't that bad out there. In the last 3 days, these safety stocks have had gigantic runs, although not as powerful as the declines in the earth movers and the metal benders were today. It is ridiculous that Wall Street could go from believing that we're going to have a decent to great economy a week ago to think it's now about to fall apart and will pay any price for safety. That's nuts. To be sure, though, we are telling club members that the news tonight about Johnson & Johnson settling with a huge plaintiff contingent for some difficult talc litigation at I think is a reasonable price for all is a huge positive. Witness the stock trading up big tonight after the close. I think we'll get some upgrades. The final camp, the one that says you should buy big capitalization tech stocks because they have just beautiful balance sheets and don't need to borrow money from banks. Are you kidding me? Are you really going to buy Amazon, betting the stock will trade higher on the strength of its balance sheet?
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.